All right, capital.crisis here, and I need you locked in for the next few minutes because what I'm about to lay out isn't speculation, it's not theory, and it's definitely not another financial media talking point meant to keep you glued to ads. This is about a specific market signal that just flashed for the first time since March 2023, a signal that has preceded every major recession over the last 50 years, with only one real false alarm. I'm talking about the Treasury yield curve inversion, and it just hit a level that should make every serious investor pause and rethink their entire portfolio allocation. On February 4th, 2026, the spread between the 10-year Treasury yield and the 3-month Treasury bill went negative by 47 basis points. That's not just a headline number, that's a threshold number. And when you understand what that actually represents, when you grasp the mechanical pressure it creates across credit markets and the banking system, you realize we're not staring at a possible recession. We're staring at the mathematical inevitability of one. The only question left is how deep and how fast. This is not a drill. This is not doom content for clicks. This is a documented, historically verified mechanism that tells you when the cost of short-term money rises above the return on long-term lending, meaning the entire foundation of fractional reserve banking becomes unprofitable. And when banks can't profit from their core model, they stop lending. When they stop lending, businesses can't expand. When businesses can't expand, they start cutting costs. When they start cutting costs, unemployment rises, consumer spending falls, and the deflationary spiral begins. Over the next 25 minutes, I'm going to walk you through exactly what a yield curve inversion is, why this inversion is different from the ones that produced misleading signals, the historical pattern connecting inversions to recessions with terrifying precision, and, most importantly, the 3 asymmetric plays you need to understand right now to put yourself on the right side of this economic transition. This isn't about nailing the exact bottom. This is about understanding the sequence, recognizing the pattern, and moving before the crowd even realizes what's happening. So shut off the distractions, grab a notepad, and let's break down the most reliable recession indicator in modern financial history and what it means for your wealth in 2026. Before we get into the current inversion and what it implies, you need to understand the foundational framework that governs credit markets and economic cycles. I call this the asymmetric dislocation framework, and it's built on a premise most retail investors completely ignore. Markets aren't random. Economic cycles aren't unpredictable. They follow repeatable patterns driven by debt accumulation, credit expansion, and the inevitable contraction that begins when the cost of money exceeds the return on investment. The yield curve is the visual representation of that cycle, and when you learn to read it correctly, it becomes a roadmap for wealth preservation and asymmetric opportunity. Here's how it works. In normal conditions, longer-term bonds pay higher interest rates than short-term bonds. That's intuitive. If you lock money up for 10 years, you demand more compensation than you would for 3 months. That relationship creates an upward-sloping yield curve, and it reflects confidence in future growth. But when the curve inverts, when short-term rates rise above long-term rates, it signals something has fractured inside the credit mechanism. It means lenders believe near-term risk is so high they demand more compensation for short-term lending than long-term lending. It means the Federal Reserve has pushed short-term rates up so aggressively, either to fight inflation or cool the economy, that they've flipped the natural order of lending. And it means the expansion has reached its terminal phase, where debt levels are so high and financial conditions are so tight that contraction becomes mathematically unavoidable. That's not opinion, that's not theory, it's a pattern that repeats with mechanical precision across decades of data. And right now, February 2026, we're watching that pattern unfold in real time. The core thesis of this video is simple but profound. The Treasury yield curve inversion that hit on February 4th is not just another data point. It's the final confirmation that the cycle launched in 2020, powered by unprecedented stimulus, is now entering its contraction phase. Historically, the lag between inversion and recession is 6 to 18 months. That means we are now inside the window where credit tightening, corporate defaults, and rising unemployment begin to accelerate. And the asymmetric opportunity is in positioning for deflation first, then the inevitable policy response that triggers the next wave of inflation. If you understand that sequence, you can protect your wealth during contraction and multiply it during the monetary expansion that follows. But you have to recognize the pattern before the mainstream media starts pretending it was obvious all along. Now let's go to history, because if you don't understand the pattern, you can't recognize it when it repeats. The yield curve inversion has predicted every recession since 1969, with only one false positive in the mid-1960s. That's a 50-year track record with roughly 95% accuracy. No other indicator comes close. Not unemployment, not GDP, not consumer confidence. The yield curve is the single most powerful predictive tool in macro analysis, and it works because it reflects the collective judgment of millions of market participants about where economic conditions are heading. Let me walk you through the pattern. In 1989, the curve inverted in May. The recession began in July 1990, 14 months later. The stock market didn't peak until July 1990, meaning investors who recognized the inversion had more than a year to reposition before contraction hit. In 2000, the curve inverted in February. The recession began in March 2001, 13 months later. But here's the critical detail. The Nasdaq topped in March 2000, just 1 month after inversion. The dot-com bubble burst almost immediately after the curve signaled the credit expansion was over. Anyone who understood the signal could have exited near the peak and avoided the 78% drawdown that followed. In 2006, the curve inverted in August. The recession began in December 2007, 16 months later. But housing peaked in mid-2006, and subprime was already cracking under the surface. The inversion was the canary, warning that the bubble built on adjustable-rate mortgages and securitized debt was about to implode. And then we get to 2022. The curve inverted in July. But we didn't see a recession in 2023 the way history would suggest. This is the false signal skeptics cite when they claim the curve doesn't work anymore. But they're missing the context. The recession was delayed, not canceled, because the Fed and Treasury executed one of the most aggressive fiscal and monetary interventions in modern history. Outside of wartime, the Treasury flooded the market with short-term bills to suppress long-term yields. The Fed injected emergency liquidity after Silicon Valley Bank and Signature Bank collapsed in March 2023, and deficit spending stayed above 6% of GDP, artificially supporting demand. The curve warned recession. Policy response postponed it. And now, in February 2026, the inversion is back, deeper and more pronounced. And the tools to delay it again are nearly exhausted. That's the pattern you need to internalize. The curve inverts when the credit cycle peaks. Recession follows with a 6 to 18-month lag. And the people who act early reposition before the contraction destroys wealth. The question isn't whether the pattern repeats. The question is whether you'll act before it becomes obvious to everyone else. Now let's look at what's happening right now in Treasuries because the mechanics matter. As of February 4th, the 10-year is around 4.18%, while the 3-month is around 4.65%. That's a negative spread of 47 basis points, one of the deepest inversions since the height of the 2022 inversion cycle. But here's why this is particularly dangerous. This inversion is happening while the Fed policy rate remains elevated at 4.5% to 4.75%. Inflation is still above the Fed's 2% target, roughly 3.2%. And the federal deficit is projected to exceed 7% of GDP in fiscal year 2026. So this isn't a clean, normal inversion. This is an inversion inside a structural fiscal imbalance and persistent inflation, meaning the Fed can't just slash rates without risking a renewed inflation surge. They're trapped between two bad outcomes: hold rates high, and they deepen the recession the curve is predicting. Cut rates, and they risk losing inflation credibility, potentially sparking a currency confidence problem as foreign holders demand higher yields. That's policy paralysis. And policy paralysis is where dislocations get severe. Now let's break down why inversion is so predictive. It comes down to bank profitability and credit creation. Banks make money through maturity transformation. They borrow short-term from depositors who can withdraw any time, and they lend long-term to borrowers who repay over years. Their profit, the net interest margin, comes from the spread between what they pay on deposits and what they earn on loans. When the curve slopes upward, the model works. Banks pay 1% on deposits and lend at 5%, earning a spread. But when the curve inverts, the model breaks. Banks pay 4.5% on deposits but earn 4% on new loans. They lose money on new lending, so they stop lending. And when banks stop lending, the credit engine that drives expansion shuts down. Businesses can't access working capital. Consumers can't get car loans or mortgages. CRE projects can't secure construction financing. The velocity of money slows, and that slowdown feeds on itself. Fewer loans mean less spending. Less spending means lower business revenue. Lower revenue means layoffs. Layoffs mean even less spending. That's the deflationary spiral. This isn't hypothetical. This is exactly what unfolded after the curve inverted in 2006. Net interest margins collapsed, credit froze, the freeze spread from subprime to commercial paper to interbank lending, and by September 2008, the global system was near collapse. The curve saw it coming years in advance. Now connect that to today because there are 3 extra pressure points making this inversion more dangerous than many prior cycles. First, corporate debt is at record levels. According to Fed financial accounts, non-financial corporate debt sits near $13.5 trillion, around 50% of GDP. A lot of that debt was issued in the zero-rate era at 2 to 3%. Now it's maturing into a 6 to 8% environment. Debt service doubles or triples. Many businesses can't carry it. That creates a maturity wall, where defaults become inevitable. Defaults rise, unemployment rises, spending falls, recession deepens. Second, commercial real estate is in structural decline, independent of inversion, but amplified by it. Office, retail, and certain multifamily categories are facing multi-decade vacancy highs, values down 30–50%, and debt coverage problems. Regional banks hold roughly 70% of CRE loans. As banks pull back lending, distressed properties can't refinance. Owners default. Banks take assets worth far less than loan value. Capital ratios deteriorate. This is the same chain reaction that fueled the regional banking stress back in March 2023, and now the pressure is rebuilding. Third, the fiscal position is deteriorating fast. Interest on federal debt is now over $1 trillion annually, bigger than defense, and growing. Refinancing at higher yields increases debt service, which increases deficits, which increases borrowing, which pushes yields higher again. That's a loop. Eventually it breaks through inflation monetization or austerity default dynamics. Either path is recessionary, and the inversion is the market screaming that it sees the fiscal trap. So, what are the 3 asymmetric plays? And this is where sequence matters more than perfect timing. Play 1, long-duration U.S. Treasuries as a deflation hedge. Yes, it sounds counterintuitive in a world of deficits. But in the early phase of recession, credit contraction, defaults, risk-off, capital flees into treasuries. That pushes prices up and yields down. Long-duration bonds like 20s and 30s can produce big capital gains during the flight to safety. This isn't a forever hold. This is a phase 1 trade. Ride deflation, capture appreciation, then rotate before the Fed pivots. In 2008, long-duration treasuries rallied over 30%. In 2020, they rallied over 20% in weeks. Your downside is limited to yield. Your upside is falling yield capital gains. Play 2, high-quality dividend equities in defensive sectors, utilities, staples, healthcare. These businesses sell necessities. People still need electricity, food, and medical care in recessions. They usually have stronger balance sheets, lower leverage, and more durable dividends. The asymmetry is you get paid 3 to 5% to wait, while buying valuations that look laughable once the next expansion begins. Defensives historically outperform in contraction, hold up better than cyclicals, and participate in recovery once the Fed cuts and stimulus returns. This is preservation positioning, not a get-rich-quick swing. Play 3, physical gold and silver as the systemic hedge. Most people think metals only work with inflation. That's wrong. Gold performs in both extremes. It rises in inflation because it can't be debased. It also rises in crisis because it has zero counterparty risk. When banks wobble, credit seizes, and defaults surge, money runs toward the hardest collateral. That's gold. In 2008, gold ran from roughly $800 to above $1,900 by 2011. In 2020, it hit all-time highs during crisis conditions. And now in early 2026, central banks, China, Russia, India, Turkey, are accumulating gold aggressively. Gold protects in the deflationary phase, then accelerates in the reflationary phase when the Fed is forced into cuts and easing. Silver offers more upside due to size and industrial demand, but gold is the core hedge every serious portfolio needs in this environment. Now let's talk timing and action steps, because theory without implementation is useless. The historical lag between inversion and recession is 6 to 18 months. We're now in month 1 of this inversion cycle as of February 2026. That gives you a window. But it's a narrow window, and it closes faster than people think. First, assess your current allocation and stress test it for recession. If you're loaded with high beta growth, speculative tech, or anything with PE ratios above 30, understand those names get wrecked first when credit contracts. NASDAQ dropped 78% from 2000 to 2002. S&P fell 57% from 2007 to 2009. Those aren't hypotheticals, they're history. Action. Reduce cyclicals. Rotate into defensives. Build a position in long-duration treasuries for the flight to safety phase, and establish a minimum 10-15% allocation to physical precious metals held outside the banking system, in allocated storage or direct possession. Second, raise liquidity, but don't park it in a low-yield savings account. Real rates are still negative in most bank products. If your account pays 2% and inflation runs 3.2%, you're bleeding purchasing power. Short-term Treasury bills, the 3-month and 6-month, are yielding around 4.6% to 4.7%. That's liquidity, safety, and a better return while you wait for dislocation opportunities. Third, prepare for Phase 2, the policy response. Once recession is undeniable, unemployment rising, GDP contracting, the Fed pivots, rates get cut hard, QE restarts, fiscal stimulus returns. That's the reflation phase. And that's when you rotate out of deflation hedges into inflation beneficiaries, commodities, energy, metals, miners, real assets. Sequence matters. Deflation first, then reflation. Treasuries first, then hard assets. Skip the deflation phase and go straight into commodities, and you can get crushed during the contraction. Follow the pattern, and you can capture gains in both phases. Fourth, build a watch list of distressed opportunities. High-quality businesses at multi-year lows. Real estate liquidations at cents on the dollar. Corporate bonds of solvent issuers trading at distressed yields because of panic. These don't show up in expansions, they show up in dislocations. And the inversion is your warning that dislocation is approaching. Generational wealth investors in 2008-2009 had dry powder ready. They bought stocks at 5-6 PEs. They bought real estate at 40% discounts to replacement cost. They held through recovery and made 10-20x. You can't do that if you're fully exposed when contraction hits. You preserve capital now so you can deploy it asymmetrically later. Now here's the question I want you answering in the comments, and I read every single one. Do you think this inversion leads to a recession within the next 12 months? Or do you think the pattern is broken this time? I want to know where you stand, because the macro debate is intense. Some believe soft landing. Others believe hard contraction. Drop your take, and here's the final piece. If this breakdown helped you, if you understand why the yield curve matters and why it's the most reliable recession indicator in modern finance, do 2 things for me. First, make sure you're subscribed with notifications on, because I'm tracking this inversion, the Fed response, and asset class rotations in real time, and you'll want the updates as this unfolds. Second, share this video with someone who needs to hear it. Mainstream financial media won't explain the yield curve until it's too late. They'll say everything's fine until the recession is already half a year old. That's not acceptable. The people who protect wealth are the ones who recognize patterns before they become headlines. The Treasury yield curve has inverted. The pattern is clear. The track record is undeniable. And the window to reposition is open, but it won't stay open forever. The only question left is whether you act while there's still time, or whether you wait until recession is official and the opportunity is gone. I'll see you in the next